Marco here from Fair Realty, Victoria, BC. We have Mike Grace back on the show. So not a lot of guests coming through, but high quality ones. So today we're going to cover a few different topics I feel are quite high level in terms of real estate transactions and also mortgages associated with those real estate transactions. So maybe we'll get started on the first topic right away. I've talked about this in a variety of other videos this year, and it's unconditional offers and using unconditional offers to leverage the best possible purchase price. I made a video a couple of months ago where I kind of concluded, depending on the situation, you can save anywhere 3 to 4, maybe 5% off a purchase price using a strategic unconditional offer. Or if you're in a competing situation with multiple offers, it puts you ahead. The reason I've been writing a lot of unconditional offers in the last year and a half is because the BC government made some changes 2 years ago by introducing something called a rescission period, where you have 3 business days to back out of a accepted unconditional offer as a buyer. And Mike here, we worked together on a lot of these unconditional offers. Mike, obviously, on the side of securing financing during the 3 business day rescission period. So, Mike, I'll hand it over to you. Maybe, give us some insight on, who you feel this is a good avenue for, if it helps, if those people are organized ahead of time, and what you can accomplish in the 3 day rescission period to minimize risk if someone's making an unconditional offer.
Yeah, for sure. And I think to start, like for me on the brokering end of things, to understand the intent of the transaction from kind of a team approach really helps set the stage for the higher level risk mitigation that needs to happen on these types of deals. So in that way, we've done a few of these purchases together over the last 12 months, and I always appreciate the communication level, between yourself and me, and that allows me to understand the scenario and the objective of, and also to try to use the rescission period and maybe plus 1 or 2 days on the front end of that, to mitigate as much risk for the customer, so that they can sort of lever the full weight of that unconditional offer during negotiations. So, I mean, who is it good for? For me, I can do this strategy with any borrowers, um, and I think the combination of who it's for is almost. I'm a little less on the ground with the customers like you are, so I would almost ask you the same question. I mean, I can perform this move and mitigate the risk. I prefer a savvier client base to do this with, but what about you?
I would say it's definitely not something I would recommend to first-time buyers, indecisive buyers. Online, a few people have chewed me out on this when I've described what I'm doing, saying, I can't believe you're basically a realtor suggesting people go unconditional, making it seem like I'm trying some sleazily, underhanded maneuver. Uh, there's some context to this. Usually, we're able to get an inspection done, etc. I guess I would allude this to it. It's kind of for a savvier buyer, for someone that, let's say, they have a TSFA RSPs and they're investing using Questrade or TD, Waterhouse, self-directed, and they're not paying, 2% MER for someone to manage in a mutual fund. So it's definitely for a savvier buyer that understands that there is some risk involved in this, but the potential upside can be quite substantial. And you always have that backstop of backing out using the rescission period, which, we actually had a mutual client this year back out. Nothing to do with financing or the due diligence. They just changed their mind. But I look at the numbers. If you can potentially save 4% on $1 million, that is potentially $40,000. But the rescission fee is only 2,500, and it takes someone to understand risk and reward, a savvier buyer. I think this is a great avenue, and I've been able to coach quite a few people into it. But it is important. I think that they work with a good team in terms of in terms of a mortgage broker that can advise them accordingly on the other end. Uh, on my end, you work with other realtors, I work with other mortgage brokers. People come to me with people they're working at the bank, and the bank will say, well, we need 10 business days. Yeah, in theory, everyone would like to have 10 business days for all the due diligence, including financing. But if you want the best possible deal, 10 business days is just not going to happen. And I'll just quickly touch on the you said 1 to 2 days ahead of the offer. That's feasible in 99% of situations, because if we're making an unconditional offer on a house that's been sitting on the market for a long time, and people are probably wondering who are watching this, why would you make an unconditional offer on a property that's been sitting on market for 4 or 5 months? Is that seller is usually frustrated, typically motivated. Sellers, there's a lot of stress often on the part of the seller in a slow market. And if you can hit them with an unconditional offer, that relieves their stress. So that house that's been sitting on the market for months, usually, me and the buyer will discuss the strategy. So there is 1 to 2 days for them to consult you in advance, typically. And if it's a multiple offer situation, a lot of the time it's delayed. The offer is
Yeah.
delayed 3, 4 days out. So there's time for a buyer to reach out to you. And, what do you accomplish in those 1 to 2 days ahead of the offer being submitted before the rescission period kicks in?
Totally. I mean, there's a sea of risk out there. And before coming on the podcast, I kind of made some notes and shared those with you, and you're probably overwhelmed reading them because it's like, how do we? There's just so many risk items that if you're not um, if you're not versed over a large number of transactions or experienced, that you're just not going to see them, or have the experience to even identify them. So I think for me, from a sales perspective and from customers watching this, like, I think the important thing to delineate first off is that the unconditional offer isn't a sales strategy, a swarmy sales strategy from a realtor and a broker. What this is it's a strategy to try to get your customer the best possible deal on a purchase. And if you can save them like 2 to 5% on that purchase price, in this type of market by doing this, it's significant. My job in that role is to try to mitigate as much of that risk as possible. And in fact, when I look at the overall sort of uh, sea of risk, um, I see the risk at the very minimum being the rescission fee. So paying a rescission fee. And I would choose to try to eliminate that risk as much as possible for the customer. So that's the minimum risk, is that the customer, we use 3 business days to go and source financing. We have some kind of hiccup um, that is unexpected, or we can't resolve within that 3 business day time frame. Then the customer may choose to pay a rescission fee to get out of the transaction. With those extra 2 days on the front end, I can usually have enough time to resolve um, as much of the risk as possible, so that there's very little risk of the customer having to resize that deal. So as long as the customer has strong intent, um, and it is ideally set up and pre-approved and has done significant diligence on their personal covenants ahead of time, just through a standard intake process. Those 2 business days plus the rescission period, that's a really, that's 5 business days. We can almost source financing um, based in that period. One thing that's super important is that we can't, with this type of deal, it may limit our lender options. So while a customer might be negotiating a significant chunk off the purchase price by doing this strategy, they may lose a little bit on interest rate because we can't do the necessary diligence across all lenders with this type of situation. I only have a select few lenders that I can sort of ensure minimal risk to the customers by doing this. So
Yeah, I mean, I would say it's probably pretty difficult to make up, 2 to 5% uh, uh, on a rate in terms of the purchase price to make up, if you're getting I mean, you've seen some of the transactions cross your desk this year. We had a recent one where I think we negotiated $175,000 off the asking price, which the week before was reduced to 100,000, and then we chopped another $175,000 off using an unconditional offer, and that was quite a tricky transaction on your end. I'm going to ask you, because the rescission period is 3 business days. If an offer is accepted Wednesday, Thursday, or Friday, it flows across the weekend and adds an extra 2 calendar days. Does that make any difference at all versus an offer being accepted on Monday or Tuesday and the rescission period being up Thursday, Friday?
I think it's helpful for sure because, and to frame that, most realtors are working on the weekends. I also do some work on the weekends, but I'll try to fit the majority of my work days in Monday to Friday. What I can get out of the weekend, um, those extra 2 non-business days, is I can set a customer up with all of the information or all of the requests that I would need to underwrite a live approval. And so it gives the customer two days of weekend non-business days to get their documents to me that I would need. And so that's helpful. Um, I think I would almost prefer doing that stuff prior to making the offer, just so that I have pure eyes on the documents ahead of time, and I can provide some extra risk mitigation um, on the rescission fee. But yeah, I mean, if we get 3 business days plus two weekend days, it is helpful um, for sure.
Is there, in terms of the lenders and the banks, when they look at these offers, do they, on their end, do these offers look any different in terms of they're not looking at an offer that has a subject to financing for 5 business days? All they're seeing is this is an unconditional offer. Does that influence anything in terms of the turnaround time or potentially creating a red flag at the lender? Or do they even really look at the conditions in an offer versus an unconditional offer? I'm curious about that.
Yeah, I think there's probably some personal judgment when, like unconditional offers have been fairly common over the last year. So I feel like even me personally, I've come to accept them as a part of the marketplace. Whereas, prior to the madness of 2021, I was like, oh, don't do that. That's, you're taking on way too much risk. But 2021 kind of like forced me and the industry in general to be more accepting of those and to find ways to, you know, um, reduce the risk. And I think in on the realtor side of things too, we saw realtors starting to do pre-offer inspections and that type of thing, which has never happened before, to my knowledge. Um, so yeah, 2021 kind of, though those days were crazy and we never want to go back there, it's given us an extra skill set that we can now lever to our customers' advantage. But from the lender perspective, the things that are going to raise red flags are completion timelines. So, that's always part of this pre-planning process is like, hey, what does your completion timeline look like? And so we'll try to knock that risk off during the offering stage, and the consulting between a realtor and a broker is like, okay, well, let's just be a little bit extra generous on the completion. What the banks view as short completions are often prone to fraud
Okay.
because they're forcing everyone to rush around and things get missed in the documents, and it's hectic and crazy. So any deal that comes in that has like a 2 to 3 week completion, it gets red flagged for fraud.
Okay.
So yeah, that's
Okay.
just a fact.
I learned something new today. Um, and then pertaining to the property, are there things you look at, let's say your client writes an unconditional offer. Are there things you look at in the property disclosure form, in the MLS data sheet that you try to isolate and say, oh, this might be an issue with the lender?
Absolutely, yeah. Each property is totally different, as you know, and like um, ideally, before an offer is made, I can get eyes on the title, the PDS, um, the the um, the MLS list sheet, the detailed list sheet. For detached homes, that's really all we need to look at. Any issue in the PDS, I don't know what's the item count in a PDS? How many items is there that the seller has to declare?
Must be like 30.
Yeah. So there's 30 items in there that could cause some concern amongst the lender. Typically, we're asked on each item that's marked off, like, what's the deal with that? And, hopefully the seller has filled out the form correctly and added subnotes to each item. The MLS listing can indicate whether a suite is long term, if there's a tenancy in place. And then we have to consider timelines around completion because oftentimes our deals are owner occupied and they rely on the lender condition of owner occupation. So tenancy can cause issues. There's legal issues on title, like probate, or if there's the odd case of like a municipal contravention listed on title. Definitely no lender is going to go for that. So there's lots of different areas on a detached home which can cause issues with financing. We can usually pick those out ahead of time. On a strata property, this becomes a little bit more difficult because the strata's business dealings play in large part to the marketability of the property when a lender is looking at a property. So if the strata's deferred maintenance, or there's issues with envelope or any kind of like membrane wording in the strata documents, we have to be pretty careful about that.
Okay.
Um,
So,
yeah,
what I'm getting from this is if someone's thinking about writing an unconditional offer, it probably wouldn't be a bad idea to send you the PDS title, MLS data sheet ahead of time. So we don't write an unconditional, or we write an unconditional offer, then turns out there was an issue with the property and then they have to rescind, right? So you can, sounds like you can get a pretty good idea prior to the offer being written, or in terms of whether there's going to be any red flags or not pertaining to the property itself.
yeah, yeah. I think there's two major risk areas, and one is the borrower, and one is the property. And in most cases, the borrower can do an intake and a pre-approval process that should mitigate most of their own personal risk. And then the property, every property is different. And, we were just talking before the podcast started about, sellers not disclosing, uh, you know, different gardening methods to the buyers. And so, that ended up being an issue after the fact. And so all of these things, super property specific, but yeah, to mitigate that property related risk, we can review all those documents ahead of time.
And what about the appraisal? Is it feasible to get a appraiser in and an appraisal submitted within 3 business days?
I think so, yeah. And an appraisal risk can be judged um, based on the customer's sort of borrowing profile and on the property. So we did have a one particular deal earlier this year where the MLS listing was very poorly worded. It was it a 70s or early 80s home, um, and essentially the list agent had written that needs a full redo,
Yeah, it was
handyman
a
special.
mid 80s house. I know the one you're talking about now. Yeah.
Okay, um, and so anytime we see like handyman special or anything like that, the type of wording, that triggers a marketability concern with the lender. So instead of doing an automated valuation, they'll ask for a full appraisal, regardless of loan to value. So I think in that case, we were able to get the appraisal done on a rush fee during the rescission, and that came back totally fine. The property was
Okay.
perfectly okay. It was just marketed incorrectly. In most cases, where the property is like solid and the listing looks nice and everything, the only thing we want to might want to consider an appraisal for is if the customer is just making a flat 20% down payment, and that's all the leeway that they have on cash.
Okay. Okay. One last question on this topic is so my professional organization, association, whatever you want to call it, I have to take 3 to 5 courses every year. These unconditional offers would be considered a no-no. We're always taught, have conditions, have a lawyer review the contract, the this, that. Like if you went to one of my courses and asked, person teaching the course, what do you think about this? Everyone would say horrible idea. Same with probably my managing broker would say this is a horrible idea. Once again, this is really high level strategy for savvy people, and I don't think it's a horrible idea if people understand the risks and the benefits. And I was just wondering if there is anything on your side in terms of your professional organization, how they would view you working and trying to facilitate financing on unconditional offers within the realm of this rescission period. I mean, as you said, 2021, it was very common. And in 2021, we didn't have the 3 business day rescission period. But just kind of how is it viewed in your industry, or is it even something that people give much thought to? Basically on my end as realtors, we're just taught mitigate liability. Don't answer any tax questions. Don't answer any finance questions. Refer to accountant, refer to mortgage broker, refer to inspector, which is all great in theory, right? But when you're out there in the field trying to get the best possible price for your client and you're trying to educate them, I can't say, hey, these are 6 professionals, consult with them. I have to, give my opinion and often time sensitive opinion to put my client in the best possible position. So, yeah,
Yeah,
just curious if there's anything on your end that's kind of
I
like Mike,
mean,
why aren't
it.
you getting offers 7 business days subject to financing so you can shop around and get your client the best rate, for example?
Yeah, you know, um, legitimately, I think I'm always trying to find value for my customers, and I think the context of that is that the broker. We've talked in the previous podcasts about the different origination channels that a customer can go through to get a mortgage. At any one point in time, um, in branch mobile mortgage specialist with a specific bank or a mortgage broker, at any point in time, one of those channels or multiple of those channels might be out of competition. and it happens to the broker channel too, and it's happened in 2024 for a large part of the year. We've had a really big challenge competing on rate. The banks are fighting it out. If you listen to or follow Ron Butler, uh, he's got an interesting podcast on YouTube. I actually like it, but um, he's calling it a mortgage war in 2024, and it's at clear disadvantage to the brokers. So where I like this strategy is that I'm able, with my experience and just with the number of deals that I have under my belt, is that I'm able to add that extra value to the client, and get them larger gains than I could, even if I could find them the best interest rate in the market, which has been something difficult in our channel for this year. Hoping it flips in 2025. We're due for the tide to come back in on rate in our channel, but at the moment, it's still exceedingly competitive in the marketplace. So for me, yeah, it's extra value that I can add, and it's something that customers aren't going to be able to get in too many other places. So for me, it's a competitive advantage.
Yeah, 100% agree with you. This for me as a realtor would be very difficult to navigate with a mortgage specialist at a branch. I mean, they would probably receive the unconditional offer, be very confused as to why an unconditional offer was written when their client is still trying to secure financing. I mean, I don't want to insult anyone. I doubt the average mortgage specialist at a branch would even be familiar with the mechanics of the rescission period. You know, just
Yeah,
base.
yeah,
It's a higher level stuff. Um, let's segue into our next topic. Buyers chasing rates and the different channels, and you just talked about it. Maybe if you can expand on it a bit, why things have been challenging. And then I want to give my personal story of um, uh, my mortgage coming up for a renewal this year and how that panned out. For me, I want to convey to people, there's more to mortgage brokers than just chasing the rate. But, maybe expand a bit on the
yeah,
challenge you've seen this year as a mortgage
yeah,
broker.
yeah. Mortgage wars 2024. I mean, what I've seen in this market is, it's crazy, and I'll have customers that will have uh, secured financing on a short conditional period, which takes significant level of attention to detail during that short period, and you select lenders based on conditional periods and timelines in which lenders are going to be able to service that approval in time for the subject removal. And then oftentimes after subject removal, there's a nice long period there between subject removal and completion where that particular customer could get nabbed or poached by a competing lender. And so what I've seen, and in particular, RBC is good on this. A lot of people bank with RBC. A lot of people have FHSA accounts set up, or RSPs, and then they'll make withdrawals under the home buyer plan, which they need RBC a letter to stamp. And obviously a withdrawal under the FHSA that's going to be used for a home purchase. So the banks are tagging people upon those withdrawals and saying, "Oh, do you have an approval? You're purchasing real estate. What kind of rate do you have?" And so they'll undercut at that stage, which is super aggressive, and they're good at it. What I would point out is that the branch staff are trained 90% in sales and 10% in actual follow through. And so things like timelines and realistic timelines to funding can be, you could drop a ball. The banks can drop the ball on that part. So super aggressive marketplace, for me to lose a deal after putting in work during an unconditional or a conditional short conditional period usually is hard news because we don't get paid until a mortgage funds. But yeah, I think, going back to your original question, um, there are strategies on how, even in this 2024 year where the broker channel is getting beat up on, there are strategies to get competitive rates with a broker, but you have to be reasonably confident and be willing to, take some risk to be able to do that. And so in your case, we arranged a variable rate mortgage at initially what was a super high rate. We got a nice discount on the variable rate mortgage at the time. Since then, the Bank of Canada has dropped numerous times. I think it's five times in a row now.
Yeah, five
And
times in a row, yeah. Yeah, I
you're,
mean, I'll just give you some context behind my thinking. So, uh, I had a 5 year fixed at 2.79%, coming due, I believe it was in August. Me and you just started the discussion somewhere in May, June. And on my end, I mean, I was just reviewing the emails. All options were on the table. I was considering a 1 year fixed. My rationale there was go with a 1 year fixed and then see what the rates do, pay the premium in the 1 year and then reassess the situation. Next year, I was looking at the 3 year fixed. The only thing I wasn't looking at was the 5 year fixed, but I was looking at 1 year fixed, 3 year fixed, variable, undecided. I think at that point, maybe the Bank of Canada had already done one drop of a quarter point. There were signs coming out that the economy wasn't so hot, which I really appreciate working with you as a mortgage broker because you're in tune with, these things versus I find, as you said, some of the people at the bank, they're just salespeople. The one thing that kind of helped me tip over towards the variable rate, which was a bit higher at the time, even with the discount, was something I wasn't aware of. That's a bit of a higher level knowledge. Is you alerted me to TD allows you to convert a variable to a fixed at a very attractive rate. Can you explain that a bit?
yeah. And um, a lot of people don't actually know that a variable rate mortgages can be convertible to a fixed rate period. So that's a big one. And surprisingly, a lot of people will get sold on lower fixed rate mortgages, and especially during this time, I've seen I've seen this happen a lot. Um, so a broker will, or a branch rep will sell a customer on a whole new mortgage. They'll pay the 3 months interest penalty to get out of the variable and jump into this new fixed rate mortgage. What nobody's telling that customer is that they could just convert probably with their existing lender into that lower rate. Conversion policies aren't all made equal, so that's not a blanket statement. Some banks, Van City, for example, they'll only allow you to convert to a fixed rate that's equal to or greater than your variable rate. So that's an awful policy. You know, like um, some banks will allow you to convert to a fixed rate, whatever the fixed rate is on the day, but your term length has to match or exceed your existing remaining. That's not bad. That's more industry standard. TD has kind of a what I think is super flexible. They allow you to convert on day one of, say, your 5 year mortgage, variable rate mortgage, to a 3 year fixed. You could also convert to a 4 or 5 if you wanted to, or 10 year. They'll do that for you, no problem. But the thing about TD's conversion method is that, and I don't want to reveal too much about it, but their conversion method allows extra discounting from what you might find at origination source through a mortgage broker or say a TD mobile rep. So there's a little hiccup in there, and hopefully the TD gods don't watch this, but there's a little hiccup in there where the conversion rates, they view that as a competition point, so they're willing to negotiate. And so it's not a straight conversion, it's a conversion with a negotiation.
Yeah, so while we were discussing my renewal, you were able to provide me all this information, which I mean, I had no idea, even though I am somewhat in the industry. So just to give viewers some concrete numbers, the best possible rate, a 3-year fixed. I checked the emails from back, I think it was late May, that TD was offering me at the time. The 3-year fixed was 5.46. I forget what the 1 year was. It was like 6.79 or something. You got me a hefty discount on the variable. I think that variable started off just above 6%, something like that. But we had discussed it at the time that already been one cut. Economy wasn't looking so hot. At this point, it's just been cut after cut, five in total, as you know, the last two being a half a percentage point. So my variable at this, as of today, is 4.63%. I think my mortgage funded in August, so we're what, 4 months, 5 months into that mortgage. I'm at 4.63, which is substantially lower than the 3-year fixed at the time, which was 5.46. If I had gone chasing a rate, and I probably could have gone online and found some lender that could have maybe got me 5.19, 5.29, I don't know, and gone into a 3-year fixed, I would not be in the position I am today. Not only is my mortgage 4.63, but there's probably rate cuts coming in the new year as well. So that will probably settle out somewhere around 3.5 to 3.75. And a lot of that has to do with, the information you were able to provide me, because knowing that I could switch into a TD fixed product at any point, that gave me confidence. If things change, rates don't come down, because there was no guarantees they were going to do 5 cuts in a row. Things don't come down at any point, I can go over to fix. And that's one thing I find a lot of people, they're chasing very small differentials and the interest rate, but sometimes they're missing the big picture. And I find someone who's really in tune and who's not a salesperson who, like yourself, lives and breathes this and has ethics, can really guide a person in the right direction. Like I think
Yeah.
over the 3 years, as you know, my mortgage, it's pretty big. I'm probably saving over $50,000 in the end, depending how low the variable goes over those 3 years.
Yeah. Yeah. And I think it's reasonable to foresee in the coming, you know, call it 6 to 12 months, that we're in a weird time where fixed rates right now are lower than variable. But I think it's reasonable to foresee those two crossing over, and for fixed rates to start to become higher than variable, or vice versa. And so specifically for your mortgage, it's a good time to, like, maybe a monthly check-in with TD on your conversion rates, to try to just make sure that if you did ultimately want a fixed rate, and I do have customers that ultimately want fixed rates, even though they're doing the strategy with the variable rate, that they just check in regularly, to make sure, even though their variable rate might end up lower than where fixed rates are gonna land. So, yeah, it's an interesting strategy. I really like it. As a specific example, recent completion was just offered 4.39 on a 3-year fixed through conversion with TD. This is an uninsured mortgage, 30-year AM. And when I got that rate back, the best that I was able to get through TD was around a 469. So there's a big, quite a big discount level there, 30
So
basis points.
you said 3 point something, not 4 point.
Oh, sorry,
Three point nine.
4.39 compared to
Okay, 4 point. Okay,
4.69.
4.39. Okay, sorry, I thought you said four
Yeah,
point nine three, but you said 4.39. Okay.
yeah,
Yeah.
yeah. And so, 30 basis points discount when converting compared to what you can find in the open market, that's not meaningless.
Yeah, no, no, exactly. And just for viewers, I mean, this is one of many, many insights you would know. I'm sure you know insights into Van City, BMO, and various other banks, depending on the scenario that your client is in. But this is where I think experience and knowledge can really be beneficial versus just chasing the best. Possible. Right. As I said, I was really happy with the service and really happy with the way it turned out. I think there was a bit of luck involved. I mean, I didn't think they would do it 5 times in a row, and especially these two so-called jumbo cuts, but to be 4 or 5 months into the mortgage, almost a percentage point lower than the best three-year fixed at that time. I'm really happy with that. Um,
I'm I'm happy to take some accolades for that because during 2021 in the froth of the market there was a lot of variable rate mortgages at that point too, and so um, you think about all of those variable rate mortgages that then saw these crazy increases, and so it's nice to get some tailwinds on the downside of
Yeah,
that
do you know
curve.
what's the other interesting thing? My TD app gives me the amortization of the mortgage.
Yeah.
When it funded, it was 30 years. It's down to 23 years and 6 months. So that's
Wow,
pretty cool too.
that's impressive.
Yeah, that's-
Not too many people also know this, Marco, but if you were feeling tight on cash flow or if customers feeling tight on cash flow, you can go and request from branch to amend your payment to go back to your original amortization period. They won't do it automatically, but you can do it manually as well.
Yeah, I got into a debate with someone about that online the other day. They were saying I should do that. The reason I'm probably not going to do that is, it's still 4.63%, and I view that as paying off, 4.63%, but that's tax free. If I went and amended the cash flow where I had extra cash, let's say to invest, and all my registered accounts are maxed out, I have to get a higher return than 4.63 because I have to pay tax on something outside of a registered account, right? So
Yeah.
at this point, I'm just happy to pay it off. Let's move into our last topic. Was it December 15th, the new CMHC rules kicked in? Can you quickly brief us on that? And we'll use a local example here in Victoria, and the numbers are crazy.
Yeah. Yeah. I mean, to the fanfare of the industry, December 15th saw our ability to essentially increase the insured price limitation from $1 million up to 1.5 million. So previously at $1 million, a customer would have to move up to a 20% down payment from the insured minimum, which is 5% on the first 500,000 and 10% on any remainder of purchase price thereafter up to $999,000. So now we can go up to 1.5 million insured, and we're also seeing 30-year amortizations available for first-time home buyers, or if the property is a new home. So it sounds great, right? So, and inevitably, we both follow Leo on House Hunt Victoria, and
Mhm.
we do see some market segmentation around the million mark.
Yep, yep, yeah.
So I think it'll spread some of that out, where a property that might be listed at 999 is now listed at $1,050,000 or something like that. So I'm not sure if that's good or bad or otherwise, um, but probably better for sellers than it is for buyers.
Yep, yeah, I'd agree with that.
Um, but yeah, I ran some numbers and I just found this totally out of interest. Is that let's imagine a scenario of um, a new home at 135
Yeah,
and
yeah,
just see what
so
these metrics look like.
just for some context, 135 brand new home, that would be something you would find in Langford, Colwood, being sold in Royal Bay by Gablecraft, West Hills, Verity, uh, and at 135 plus GST, you could find a new home with a suite from one of these developers, and in my estimation, the suites in most of these homes would rent somewhere between $1,700 to $2,000 per month. So the
Yeah,
example you're giving is what I'm trying to convey is it's a realistic example in Victoria. On the West
yeah,
Shore, you're not buying a new house in the core for 135.
yeah, and that 135 brand new build in Royal Bay, West Shore, it's going to be a nice home, no doubt. Like, so it's a solid home, but let's imagine that. Um, and what I want to display here is the message of all of our collective governments talking about the housing crisis, but the cost inputs um, that nobody really understands that the federal government and the provincial government and all of these governments are making on a real estate purchase and adding to the cost and adding to the crisis point of our housing. So let's just jump in. And, you know, Marco, we've talked about before about uh, industry perceptions. It's, if you go on Reddit, it's really easy for mortgage brokers and realtors to,
Yep, yep.
we get our backside spanked on Reddit pretty hard. But I'd love to take this in a different conversation or a different direction, and for people to realize what direct costs the governments are adding to these transactions, because it's when you compare it to a realtor's fee, it almost looks like all in to make the realtor's fee look completely reasonable. And that's not even a sales pitch, but so here we are. We have a 135 purchase price, new home. The GST on that is $67,500. Okay. Um, Imagine that the customer is using these new insured guidelines and is making the minimum down payment, which is great. Okay. Um, and they're a first time home buyer. It's a new home. So they're going to get the 30-year AM. Their mortgage insurance is going to cost $54,000, $54,600. Okay. So we're already, 67,000 in GST plus another 54 going out to CMHC. So we're already somewhere around 120,000, right? Well, let's just add in the property transfer tax, because the government or the provincial government's got to take
Yep.
its share. That's an extra 25,000. So all in to the government on this, before you start paying any mortgage interest or anything, you're probably looking at close to 150,000 going directly to the government. And I'm calling the CMHC the government because it's government backed. Um, there are a couple of private insurers in addition to CMHC that would gladly collect that fee, but it's essentially a government backed. All of those insurance companies are government backed. So 150,000, and let's say if you had to sell that home and you had to pay your list agent and a cooperating realtor, those fees are going to come in at about 45,000. So again, the comparison for the Reddit world, don't just direct your your blame to the housing crisis at the realtors. The government is heavily to blame here, and it plays a big part in adding costs. And this doesn't even include development costs.
Oh yeah, no, we're missing a ton of costs here, and 45,000 to sell the property. That's a lot of money. There are a couple of agents involved, a listing agent, a buyer's agent. I feel like is the value exceptional there for 45,000? Maybe, maybe not, but certainly better than the CMHC stamp. That's what, $54,000. It's literally a piece of paper.
Yeah,
That's
yeah,
fifty-four thousand
yeah.
dollars. Yeah.
And if you look at insured mortgage default rates, they're exceedingly low. And I think, like, where does all of that money go? Like, what does CMHC do with all of that money and Sagan and Canada Guarantee? I mean, they're
I,
printing profits.
Even though buyers buying this $1.35 million home with a minimum down payment, even though they would be highly leveraged, I would think, given the income required, that they would probably be low probability to default because it would probably be professional, stable jobs.
Yeah, absolutely. I mean, assuming they have good credit and no other real debt, they would need an income of about $266,000 per year to qualify for that loan. And I think that's the other side of this change in industry that hasn't it's been talked about a little bit, but not too much, is that a lot, a minimum to qualify for these loans is going to really only suit a very small percentage of the population. 266,000 of family income. I mean, if you play that up against median, what's the median in Victoria? It's somewhere around between
That was
85
I
and
thought it was
95
I thought it
or
was approaching 100, approach like somewhere around not if it's 100, it's 101 or something like that. But
yeah.
uh,
I mean, monthly payments.
I would just think that someone who's making 266,000, you think they would have a decent savings rate where they would have a bit of a stronger down payment. But as you say, I mean, I don't know, maybe more so in markets and Vancouver, Toronto, maybe even Calgary, because there are some oil jobs there. But uh, I mean, you would know better, but I just don't have a lot of clients in my business that fit this mold. I certainly have clients
Yeah,
fitting
I
the
agree.
mold between 160 and 200,000 family income, but 266 is, before we started the podcast, you said this is a good program for doctors, and beyond that, yeah, it's, someone very talented in the IT sector or something like that. But, nurse and a tradesperson, teacher, and a lot of these combinations, especially starting out, are police officer and some other professional, are kind of 200, not 266 plus.
Yeah, yeah, and we are seeing big wage increases amongst those strong public sector jobs, nurses, firefighters, police officers, and there's lots of those jobs in Victoria. And so a dual income family, where say you have a nurse and a firefighter, we're getting close probably right now to 210 to 230, if they've been in the job 5 plus years. But 266, that seems to be a step function quite a bit larger. Um, and where I've seen that type of income is, yeah, new doctors, um, or fairly senior tech workers, or tech workers that are working remotely for like Apple or Google, and those positions are becoming a lot less common up here now.
Okay. And then, I'm looking at the numbers, 6,500 a month for the mortgage. Do you see do you process a lot of mortgages that are over $5,000 a month? Is that a common thing?
No, no, I mean, Uh, I
Is that
I
because people are buying with equity?
I just feel like people buy on payment, and where the loan amount lands is kind of independent of monthly payment. And I would say probably my feeling on market is that most people look at payment and be like, that's doable. We can do that. They're not necessarily looking at the size of the mortgage. Um, $6,500 a month, it's pretty rough. Um, you know, I think I think what you have to compare it to is that if a customer needs a detached home and they need that for their family, and their only option is to go and find that in a rental at say $3,000 or $3,500 a month, they're going to be happy to purchase within that same monthly payment range as what the rents are going to cost. And if the home has a suite and can offset part of that, that's like a nice bonus. Um, do we see people pushing that, their uh, monthly rent payment plus, what a suite would bring in? Yeah, sometimes, but not in this type of market.
Okay, that's I've never looked at it that way. So you're saying if someone's paying 3,500 a month in rent, and they could go out and buy a house. The suite would rent for 1,500. They might be comfortable with 5,000 a month to service that mortgage, but they're probably not going to 6,500, 7,000. Yeah. Okay,
And
that makes
again,
sense. Yeah.
once you get into those big payments, you need those big income
Big
numbers to
incomes. Okay.
qualify. Yeah.
Okay, and finally, to put you on the spot, what are your predictions in terms of mortgage rates for 2025?
I think we'll see the crossover between fixed and variable, just as, and I think that process will be part of a larger overall process where the um, the shock waves of COVID are slowly being reduced. Um, though, there's always geopolitical events that could throw a wrench into things. We'll see what happens when Trump gets into office, and if these tariffs are going to be a thing that could be a large provide a big driver on bond yields and mortgage rates here in Canada. Um, yeah, I mean, the federal government is likely due for an election. Well, 2025 is an election year, so there's probably some upheaval there. Um, Overall, I don't.
What's your best guess on yeah, the overnight lending rate right now is 3.25. Where do you think that settles out end of 2025?
I definitely see at least another 25 bips reduction, and beyond that, it's kind of unclear. Um, on the ground guidance, if I can get a fixed rate under 4% for my customers on a 5-year deal, I'm going to be happy with that.
Okay.
So under 4%
Hmm.
fixed rate. Yeah, if we can do that, I'm going to be super happy. I was able to get a couple of those done this year. On those were insured deals, and we're back up a little bit with a bump in yields lately. So we're just over that 4% range now. But if we could land in the threes, that would be nice territory to be in.
Awesome. Well, Mike, thanks for having you on the podcast again. Let's do this in another 6 months. For those watching, if you want to put a question in the comment section on maybe some other topics I can discuss with Mike in the future, kind of higher level stuff, not, where you can find the best possible rate as you kind of got away from this discussion. Uh, Securing a mortgage goes beyond just the rate. There can be a lot of strategy involved that can definitely outweigh any rate savings. Not to say that Mike can't get you the best possible rate, but there's more. There's more.
No,
There's more to it, especially for people that are kind of in tune with things. And yeah, Mike, do you want to finish it off with anything?
Yeah, totally. No, I mean, there's all sorts of extra context, and I always encourage people just to, if they have any questions on it, I'm kind of an open book. So I'll often, uh, if I talk to 10 people, inevitably I'll tell five that they can probably get a better deal by doing X, Y, and Z that doesn't involve me. So I think
And
I'm a
that's
bad salesperson,
you
but
know what, when I refer people to you, I always tell my clients it's like, no, like this guy is super honest and ethical. Like if there's uh, an avenue for you to be had that doesn't involve him, he'll let you know, right? And I feel like I'm
yeah,
the same. Sometimes people phone me and say, "Hey, listen, my colleague's thinking about buying my condo. What do you think? Should we list it?" And I'll say, "Hey, listen, like I could never get this price on the open market. Sell it to your colleague." And this actually happened to me this past summer. Uh, in View Royal, a guy emailed me and said his colleague was interested in buying. I'm like, sell it to your colleague because I can't do better than this. So
yeah,
yeah.
yeah, yeah. No, it's I like having a purpose and outside of just pure sales, and I feel like that's why we resonate together. You feel that same purpose in offering a unique value sense to your customers. So, um, but no, I appreciate being on the podcast, and I'm wearing the Christmas lights. It's December 19th. I know if somebody's watching this YouTube video
Yeah.
next summer in June, just so you know, I'm in the festive spirit, ready to wind down for the holidays. So, Merry Christmas, everybody, even if you're watching in June 2025.
That's awesome. Okay, we'll
Yeah.
call it a wrap there, and until next time.